We should be all set with the streaming.
Okay, let's call the meeting to order. Let's see. Lori, do you want to start with the roll call?
Yeah, just one moment.
And good morning, everybody.
Morning. Good morning, Lori Carney, Clerk of the Board. Perry Salonia,
Present.
Lazaro Guzman,
Present.
Al Lebo,
Here.
Brittany McGilpin,
Here.
Peter Privitera,
Here.
Mayor Cantor,
Here.
Matt Hart.
Lori, Matt cannot make the meeting this morning.
Okay, thank you. Chris Kashmar,
Here.
Rick Ledwith,
Here.
Paula Kanaki.
Here.
Is there anyone else who's attending whose name I did not call? Okay, Lazaro, we're ready.
All right, thank you, Lori. And again, good morning, everybody. Welcome to the January 24th special meeting of the West Hartford Pension Board. My name is Lazaro Guzman. I'm the chair of the board. This meeting is being conducted in a virtual format in accordance with the Freedom of Information Act, as amended by Public Act number 21-2, which authorizes municipalities to conduct public meetings virtually. Members of the public can view the meeting live on West Hartford Community Television at www.whctv.org and www.youtube.com/WHCTV5. The meeting is also being recorded for on-demand viewing and will be available on the town's website for at least 45 days. Since we're conducting this meeting in a virtual format, there's some special rules and procedures that I need to cover before we begin. First, I ask that all participants mute your device when you're not speaking. If you wish to be recognized, please raise your hand and I will call on you in the order I see hands raised. If you're participating by audio only, or I do not call on you and the debate is ending, then unmute your phone and let me know so that I can recognize you. Second, main motions will be made by me and no second is necessary. We will proceed immediately to debate. These include motions to adopt, receive, or approve business items. Subsidiary motions still require a second. These include motions to amend. A member must be recognized before making a subsidiary motion, but any member can second a motion by just unmuting their line and saying second. Third, all speakers must make a good faith effort to state the person's name and title at the outset of each occasion that such person participates in the meeting. Fourth, all votes must be taken by roll call unless the vote is unanimous. Fifth, a reminder that if any participant has a problem with connectivity, you should immediately call Lori Carney, whose phone number you were provided earlier. She will let me know and we will recess the meeting while the problem is resolved. If it cannot be resolved quickly, we will ask you to call into the meeting using a phone and participate via audio only. All right, those were all of my opening comments. With that, good morning, Chris, and I'll turn it over to you for the investment review.
Great. Good morning, folks. Good to see everyone and trust you're all well. I think we really have, as indicated on the agenda, two items to catch you up on this morning. One is we've got some preliminary results through the end of the calendar year for both the pension plan and the PBoC pool. So we'll catch you up on that data. And then moreover, we did want to introduce, using our latest version, if you will, of capital market assumptions, some asset allocation analytics that we wanted to introduce, and suspect we can use those in forthcoming meetings as we work our way through completing the dollar cost averaging exercise, and then what implications that larger portfolio size may have for the construction and characteristics of the portfolio going forward. So I'm hoping and trusting that everyone has access to the slide deck that Lori sent around. The larger of the two. If you open that up, I'll hit some of the highlighted pages here. Bear with me here. I'm going to do the same thing.
Chris, did you want me to try to share that material?
That'd be great, Lori, if you'd like to. Sure.
I'll give it a shot.
I know I have problems in WebEx for some reason. I'm not sure if it's on my side, but.
So which one am I going into right now, Chris?
It's the January meeting materials, Lori. Would be great. Thank you.
Can everybody see that?
We
No?
see the folder. We don't see the content just yet.
Okay, because I'm viewing it right in front. I've got it on the screen now.
Or maybe if you minimize that slide, the other one will come up.
Minimize. I'm not sure which. Let's see. Now, can you see it?
There we go.
Yes.
All right.
So if we could, Lori, we'll scroll ahead here and I'll highlight just certain pages. So we'll start with the asset allocation study, and there's some, hopefully folks had the chance to maybe glance at these quickly, so I won't reproduce all the related content, but we kind of start, if you remember, each year we formally recast our capital market assumptions on a go-forward basis, and use that as in the process of evaluating the portfolio and its return potential and some of the risk characteristics. So we just completed that exercise in December. And kind of an interesting, if you skip, Lori, ahead to just the very next page there, we can probably highlight here. You'll see one more. Year over year assumptions. There you go, right there. Perfect. Thank you. So you do see here year over year, our assumptions actually go up a little bit by asset class. And that really is a byproduct of a couple of things. One is these are nominal returns, as you know, and expectations for inflation, as you've all read, have moved higher year over year. So on a nominal basis, that's been a little bit of a tailwind for absolute returns. I would remind the board that when you decompose these returns into their real components, for example, that the story's a little less constructive. As you know, real returns in the fixed income markets are very low and in some cases negative. So that's just something to be mindful of. And then on the equity front, globally, you see returns moving a touch higher. This is the 20-year forecast as indicated at the top of the page. And without boring you with all the gory detail, we use a cyclically adjusted earnings yield methodology to create these returns. Earnings picked up very dramatically, as you may remember last year, and in fact outpaced stock price movement. So that is somewhat of a tailwind. Again, I mentioned the inflation effect also. So our returns are up nominally year over year for the full 20-year forecast. So this is the basis for taking the actual asset classes that the pension trust currently uses and building out, again, that return potential that I talked about earlier. So if you skip ahead, Lori, to then I think we've highlighted that. There you go. Now these I don't know if we can blow this up or not, but what we've done here is we've got the current target allocation. You can see it, the 70-30 mix, right, that you're all accustomed to, equity, real asset, and fixed income. And over a 20-year forecast horizon, if you can make it out, the expected annualized return using the inputs we just introduced is 6.6% per annum. And remember, the way we create these returns is absent manager contribution, right? This is just pure asset class return, and what we expect if you're allocated precisely at your target mix, what you may earn over the next 20 years. It's interesting, if you look in the very upper right-hand corner of the page, you'll see the actual returns associated with that mix historically are actually well north of 6.6%, but we've talked a couple of times in the past, as you'll remember, about this dynamic of we're in somewhat of a truncated return period right here. And this is, I think, industry-wide, right? If you talk to anyone who's kind of putting forth these types of assumptions right now, they are somewhat diminished from where they've been historically, just given the hurdles are higher as markets have continued to perform. So that's got one guidepost. The other guidepost, of course, is we're trying to model, as you all remember, to a 6.25% return. So we take the liberty there using the current asset classes that the board's been comfortable with of reconstituting the portfolio. And if you can make it out there, the second line, excuse me, current asset class, you see we actually here can de-risk the portfolio a measure and still achieve that 6.25% return, right? Again, absent manager contribution. So no surprise there, right? The basic lever is a little bit less equity and more fixed income. There's a little bit under the hood if you were to go into global equities of a reconstitution of the mix, tilting a little bit more favorably to international equity vis-a-vis domestic. But that would be something for us to think about and consider through time, and we'll bring this all together, I promise, momentarily. Finally, what we do in the third version here is we just say, let the model run and take the portfolio from a statistical sense where we think it could go, utilizing really all asset classes under the hood. So you see there, no surprise, right, in a optimization scenario, right? These methodologies love to diversify, right? So there's no surprise there, right? When you look across the entire spectrum of asset classes, that it draws in things like dynamic bonds and dedicated high yield and global bond and marketable alternatives, i.e. hedge funds and private equity and a whole host of other asset classes. And you see a return profile very similar to your de-risked version right above it with a tad less risk. And again, right, that probably is intuitively appealing to the board when you're using more asset classes. So our motivation here wasn't to make changes or recommendations this morning. We wanted to introduce this framework to the board, and our expectation is maybe at the February meeting, when you have a chance to digest it, we can talk a little bit more explicitly about actionable items. Right? You'll remember we're just halfway through the dollar cost averaging of the POB proceeds at the end of the calendar year through early January. We did round 3, as you'll remember. So we're just about halfway there. So I think the timing works very nicely in the sense that as the portfolio continues to size up and become bigger and bigger, just in terms of the corpus, what appetite you folks on the board might have for either asset class diversification or even within existing asset classes, right? As we, is there a discussion to be had around manager sizing? And should we begin to think about maybe introducing some additional managers to the program as the portfolio gets bigger and bigger? So those are kind of the things that we wanted to toggle on this morning. Again, nothing to act on just yet, but we did want to get those new assumptions in front of you. We did want to show you some of the implications. And we did want, hopefully, with the benefit of a few weeks with this, maybe come back in greater detail and analysis at the February meeting if there are items and actions that you may want to take in terms of the portfolio's allocation and its underlying construction. So with that, Mr. Chairman, I might just pause for a minute. And again, I know there's a lot here and don't expect to have answers again, but we did want to introduce it and see what questions the board may have, at least in an introductory fashion.
Thanks, Chris. This is really helpful. Just so I understand, just to kind of summarize. So the allocations today, based on the revised or most recent capital market assumptions, those would result in an expected return of 6.6, right? As I'm reading.
Correct.
Yeah, and so I think that's pretty close to what we've been assuming when we did our analysis of the pension obligation bonds. The other ones, basically, we give up about 30 basis points in expected return, but we lower the risk profile on the margin. So is that how I should think about these?
That's correct. Yep, absolutely.
Okay. So one just final point, did you look at sort of, because I think, it's really helpful, and so we've got some stuff to think about for February, but I guess one scenario that I'd be curious is, just because I think, we do have a certain expected return target, again, based on some of the work we've already done. So the other, I guess, angle on this is, how do we keep a similar risk profile, but maybe move a little bit closer to that efficient frontier, and sort of maybe what sort of asset classes, or how do we move that up and maintain the current risk profile, if you get my question?
Yeah, so we can, Mr. Chair, absolutely do that. I think probably, what it's going to take is two things. One is, the way that the mix becomes more optimal, I think, as everyone can appreciate. One is just by maybe accepting directionally the output of the model. And what do I mean by that, right? If you look at the current target allocation versus your current asset class utilization mix there, the two blue highlights, right? Under the hood there's the equity versus fixed income, a toggle to the 6.25, but moreover, you do see within equities, as I mentioned, a little bit of a reconstitution. So that reconstitution, if accepted, I think gets you closer to the efficient frontier. And then moreover, the fully unconstrained, right? No surprise to the group again, to the extent that you let capital go to some of these diversifying return stream asset classes, right? Like we talked about, so under the hood, some of the differentiated bond strategies, and then moreover, some of the alternative arenas like marketables and private equity. That statistically is going to improve, right, the risk return analytic as well, and kind of move you to that efficient frontier. So,
right.
again,
No, I understand that, but that's moving to the efficient frontier going left. So going left and going down. So my question is, I think there's a way to move to the efficient frontier, one, without giving up, the 30 basis points. I don't know what that looks like, or keeping the same standard deviation and moving slightly up, right?
yeah, so we can model for that, absolutely, if you'd like. If you'd like to see that, we can certainly do that. On
the margin, I mean, I think we'd try to keep the same expected return and try to minimize the standard deviation. I think that that would be attractive. I guess from my perspective, reducing risk is always attractive, but I think just kind of given where we are with the POBs, I wouldn't jump at the opportunity to kind of reduce the expected return by 30 basis points. So I'm curious, how do we either keep it the same and reduce the risk, keep the expected return the same and reduce risk, or kind of keep the same risk profile and maybe just move marginally higher?
we can certainly extract both of those outcomes for you from the model. So that's good direction for us. Anything else from the board? Other requests, or looks like there's a couple?
Let me start with Alan. I saw his hand first. Alan, go ahead.
Yeah, thank you, Al Lebo, board member. Chris, it looks to me like in each situation here, we're reducing risk by increasing the fixed income portion of the mix. In light of low interest rates and Fed policy and stuff like that, I just wonder what your thoughts are as to whether that really reduces risk or not.
Yeah, it's a great question, Al. Chris Cashmore, Fiducient Advisors. So, it's interesting, right? Because maybe my answer is better framed if you look at, so as the backdrop, right? I think we all accept the fact that we've still got low base rates, although they're increasing, and we expect interest rate volatility to be persistent here. And moreover, right, that probably on balance is kind of a headline challenge to fixed income returns. The portfolio today, as you all know, is confined to intermediate duration, high grade fixed income, which has been perfectly fine. It's interesting, right? Look at the unconstrained version of the model, Al, to your point of that, and where it kind of takes you into other areas of the market, which have maybe return and potential profiles that are a little bit different than just the core fixed income markets and the sensitivity to interest rates you get with that exposure. I look, for example, at unconstrained bonds, dynamic bonds, as we label them here, which you'll remember we've introduced to the board in the past, which basically is a template for a manager really to have a much larger toolbox and to create yield profiles in their fixed income return programs without necessarily introducing a lot of interest rate risk. So that's obviously one kind of intuitive outcome, right? You see that step into things where you can defend yield, search for return, but maybe do so with a little less of a duration profile. High yield bonds, global bonds, obviously in a vacuum have higher yield profiles going forward than the core markets as well. So it's interesting to me that when you unconstrain things, that the model does take you to some of those kind of satellite areas of the fixed income markets and away from some of that interest rate sensitivity, I think, that you pose. So that's maybe something we could look at on a go forward basis too, is dust off some of that collateral and share it with the board.
Yeah, I guess I just question how much the model really can take into account, Fed policy, Fed direction, and whether there's really more risk involved in fixed income right now than the model would think there is.
Yeah, it's a fair point. It's a fair point. And then, but we can do some more work there for sure.
All right, thank you.
Great.
Perry Slonia, board member. So what I'm going to ask is about the 6.25% rate. That seems to be what is some sort of a target. So my question is, when I look at what's been used as the rate of return for both liability discounting, and then obviously for assumed asset return, it's 6.99%, at least what I could see. So could somebody explain to me the disconnect between the two, or has it been lowered down to the 6.25? And if it hasn't been lowered down to the 6.25, is there some anticipation that it's going to be? So if somebody could kind of fill me in on a little bit of the history around that assumed rate of return, that'd be great. And then I do have a follow-up too.
Peter, go ahead. You want to take that?
Yeah, Pete Privitera, a finance director and board member. Perry, over the past, I don't know how many number of years, we've been gradually reducing the discount rate by 1/8%. Our last reduction was to 6.99%. When we started the discussion on pension bonds, one of the, I guess the selling points, one of the points that we're trying to make to the rating agencies is that we would adopt a conservative asset growth discount rate, which was 6.25%. And we all agreed, the pension board agreed, the town council agreed that that was a very conservative rate. One thing we wanted to do was we wanted to convince the rating agencies that we were serious about the pension bond pension obligation bond issuance, and that we were going to be able to support it. So that's the reason why it was dropped to 6.25% from 6.99%.
Okay, Perry Sloan Pension Board. So it actually has been dropped down to 6.25?
Yes, the discount rate from when we presented to the rating agencies and also to the state treasurer and state OPM, our model indicated that we would use the 6.25% discount rate in our modeling for the duration of the pension bonds, which is 25 years. Obviously, times will change down the road. We'll have to react to the market, but that's what we have right now in the current fiscal year, 6.25%.
Okay. Thank you very much. That's helpful.
Peter, just to clarify, that's what we're using for the pension obligation bonds, but for the purpose of the valuation, we're using 6.99, right?
No,
No?
the valuation is based on 6.25%.
Okay.
Okay. And so, I don't haven't formulated my thought fully on this one yet, knowing that information. But, I think if we are at a 6.25% rate of return, and that is the bogey, then I'm all for trying to structure it in a certain way that reduces or minimizes that risk. But if there's appetite, that's for we could talk about it to increase it, like Lazaro is referring to, across that efficient frontier. With the exception of some additional risk, then that's something obviously what we can look at too. But thank you very much. That was helpful to kind of understand where we are and how we arrived at that 6.25, because again, I was seeing a little bit of a disconnect there. And then my last question for Chris and maybe you as well, Lazaro. When I look at this unconstrained 6.25% portfolio, one of the things that I looked up against is the investment policy. It doesn't appear that there's any target for some of the alternative class. I see a top rate of 10%. So I don't know if there'd be some work that would need to be done there to recreate or recraft that investment policy so that it's aligned with whatever recommendation Chris might put in front of us. So food for thought. But if there's some things that we would need to do in advance of February or shortly after, I do want to point that out.
Thanks. Yeah, and I think we would make sure that if we had to edit the policy, that's a great point. We would do that at least at a minimum shortly thereafter. Al, you have another question?
Yeah, thanks, Al, Lebo, board member. I just wanted to get clarification on this valuation rate question. I understand we're using 6.25 for all purposes, and yeah, I'm certainly in favor of the 6.25 rate. I didn't think that we had officially voted on that and changed that for valuation purposes. Am I wrong on that?
Go ahead, Peter.
Pete Privitera, board member and finance director. Yes, when I brought the pension obligation bond package per se to the board, one of the discussions that we had was we had to assume, or what was recommended was the assumption of a 6.25% discount rate. And that rate would be constant in our modeling and constant until the board made a determination in the future whether or not they wanted to, increase it or decrease it, depending on board's reaction to what the market conditions were.
Okay, thank you.
Any other questions related to the capital market assumptions or the asset allocation? And Chris, just to kind of clarify my point before, I'm not really looking to, given that we're using 6.25, I'm less interested in maybe moving sort of up with the current risk profile. I mean, if we can move up marginally and keep, the same risk, that'd be an interesting data point. But more, can we move left towards the efficient frontier, but maybe not necessarily give up, kind of from the 6.6 where we're at, and recognizing that the other ones that you've presented here are more in line with what's being used for pension obligation bonds, but maybe is there an opportunity to sort of stay where we are from an expected return perspective, but then reduce risk without reducing the expected return?
Great. Good directives for us, and appreciate the board's great input there. So we'll model that out and bring that information back to you in advance of February. If there, Mr. Chairman, no more questions, Lori, if we forge ahead, I think our other agenda item was just a quick catch up on performance for the portfolios through the end of the calendar year. I would just caution the board, I view these numbers as preliminary, at least the relative numbers, because a couple of the indices hadn't loaded yet at the time of production. I think the absolute return numbers for the portfolios are pretty darn close, but the relative performance will probably tighten up a little bit when we deliver the final reports to you in February with the benefit of all that detail. So if we, Lori, I think in this deck, continue to scroll ahead here, we'll hit only a couple of highlights and we can backfill this again in February as the board sees fit, but we did want to just quickly catch up on a flash basis. If you scroll ahead to the next page there, perfect, thanks. Just as the year begins, I think as everyone knows, we've gotten off to a little bit of rough sledding in January of this year. As you all know, equity markets globally are down, with the exception of emerging market equities, interestingly enough, and interest rates are up as well, so bond prices are down. So a little bit of in the way of headwinds very early in the new year. More broadly for the across the entirety of the year, this idea that heightened capital market volatility is likely to persist is something I think that we share and are indicating to clients. And moreover, we talked about those forecasted returns going up a little bit given what happened with inflation and some of the other dynamics over the long haul. But I think if you truncate that forecast period down to the much shorter time frame, right, there certainly is an opportunity, as we've seen to date, near term, for maybe some moderating returns as markets continue to recalibrate to new Fed policy, ongoing challenges with variance and all the things that we've read about and I suppose unfortunately become accustomed to. So I think you got to kind of strap on the boots again and expect a little bit of volatility here as we've seen year to date. If you scroll ahead, Lori, to the next page, if you would, you know what, we'll come back to these details, I think, in February. This just kind of speaks to the idea that heightened capital market volatility, somewhat truncated return expectations, but nonetheless expectations for global growth in 2022 and 2023, although it's somewhat of a moderating clip. That's what it's basically the takeaway on that chart in the upper left-hand corner. So the macroeconomic footprint, we think, can still be constructive for returns over the course of the next couple of years. Moreover, I'll remind the board, as I think as you all know, in past rate hike campaigns, equities, things like equities and commodities have actually generated decent, solid returns despite those higher rates from the Fed, for example. Fixed income, as you would expect, right, a little bit of a tougher go. And then the other big thing on this page, we've obviously had lots of headline issues around inflation and inflation running higher. We expect inflation does run higher here for the period of the next several quarters as supply chain disruptions and the like recalibrate, although we do think that inflation does come back to more manageable levels, a few quarters out. So with that, if we could, Lori, just continue to scroll here. There's collateral for the board's edification on the fixed markets and the equity markets. I think we'll set aside, in the interest of time this morning, we can come back to next month. But if we scroll right ahead at a page or two here, we'll have the depiction of the, there should be a page or two ahead here. You keep going, you should see the pension portfolio. I think maybe a page or two up there was. So there's the portfolio at the end of December, if everyone can make it out. $384 million. We were putting $54 million to work over calendar year end. sourced from the POB, of course. So those monies will have flowed into the portfolio and have been allocated according to your specifications. Running pretty closely to target, as you would expect, given the dynamics around the dollar cost averaging and how we're doing that. In terms of the portfolio itself, I think it's generally in good working order at the manager level. I'll remind the board, we did elevate MetWest total return to discuss on a portfolio management retirement that's taking place that we're monitoring, but I think that will settle in just fine and we won't have issues there. But otherwise, the lineup's in good working order. If you scroll ahead, Lori, quickly to the next page, and then I'll pause for a moment, you'll see for the quarter, the portfolio was up a touch behind benchmark, but not dramatically so. And then you see that for the 1 year period ending in December, I'm trying with my terrible eyesight, I think that's 13.2%, Lori, if you blow it up. And the track record longer term, I think that the board's become accustomed to. Again, those numbers might tighten up a bit in the near term when we have the benefit of all of the index references. But the portfolio had a good year. I think since the beginning of July through the end of December, back of the napkin, the portfolio is up about 3.5% if you do the arithmetic. Now, I will again remind everyone that January has been somewhat tougher, but just to give you some perspective on where we stand in terms of those first 2 quarters, if you will, of the POB era, for lack of a better term. So I'll pause there for a minute, Mr. Chairman, see what questions that the board may have just on the quick pension view here before we look at the dollar cost averaging pool.
Chris, were you gonna maybe comment a little bit more on some of the managers? I thought we also had a manager on watch, right? We had what's that?
I think we had MetWest on discuss, correct?
We did. Did we not have one of the international funds on? We can go back to that. I thought one of the international funds was on
You
watch.
scroll back, Lori. Did I let me see.
I think I remember that from the minutes the last time.
Yeah, I thought I remember. Yeah.
What page?
Harvard, what I think Harvard Diversified we might have elevated to watch, right, on a couple of members of the portfolio team had left in the emerging market area, and they had added some new folks recently.
Chris, I'm not sure what page you would like me to go to.
Yeah, I think the page you were just on, Lori, that showed the portfolio. There you go.
Here?
Right there, just as right there. Yeah. I think it was Harvard Diversified, right?
Yeah.
On watch. Again, for a portfolio management change, not so much for performance reasons. If you scroll ahead to the chair's question, just at the individual manager level, if you scroll, Lori, one more page, you'll start to see the depiction here, right, at an individual manager basis of performance. I don't think anything in, right, quarter to quarter, things will fluctuate a little bit in terms of relative performance, but I think longer term track records generally, as you work your way to the right on the page and you have the benefit of those fuller return cycles for each of the managers, I think you generally see constructive outcomes, right, by and large across the roster. But let me pause there, Mr. Chairman. I don't know if there were particular managers that you had questions on.
No, just yeah, I was looking for an update on the international manager. Any questions for Chris on any of the managers or anything he's covered so far? All right, Chris, proceed.
So we did want to quickly catch up on the POB pool as well. Excuse me. So if you, Lori, would scroll ahead, just there you go. Right, one back, one forward, I guess.
Here.
No,
Page 27 or 28.
Yeah, no. If you go back, go back one more. There you go. So there is the PBoC pool just at the end of December. So you see, as I mentioned, right, the 54 million there, that money was en route, right, over the course of the end of the year from the PBoC pool into the trust, right? So that money, and again, was directed in accordance with your edicts. So that's why you see the carve out there. But otherwise, in good working order in terms of Baird, Payton, and the Vanguard short-term fund, you know, kind of again, I think all doing as advertised. If you scroll, Lori, to the very next page, just to highlight quickly, the portfolio is running, you know, I think about as you would expect it would be. There's a little bit of frontline pressure, right, given what rates have done. But again, we don't have a lot of interest rate sensitivity in this program. The design is to kind of lock it down from a principal protection perspective, right, as best we can. And I think the program generally working in accordance with expectation given the investing backdrop. So not much more to report on that front. So that portfolio, right, kind of positioned back to those three funds. And then at the end of March and to across April, right, we'll have a stage 4 of the dollar cost averaging effort. And we'll keep the board apprised of that, of course, but I'm happy to take any questions that you may have.
I don't see any questions, Chris. I think we're good so far.
So I think, Mr. Chairman, Chris Cashmore, Fiducient Advisors, I think that's all I had in terms of updates for the board, and then with some follow-ups as you directed for the February meeting that I've noted.
Great, Chris. Thank you for the update. Very helpful. Let's see. Moving along on the agenda. So next, we did want to go over the pension plan dashboard. And I was going to present that. He worked on this dashboard with Ethan. If everybody recalls, we had talked about it a couple times at previous or in some of the previous meetings. So I think it's in pretty good shape where we thought it made sense to share it with the broader group, and then kind of open it up to questions.
All right, Laz, did you want me to?
Yes, Al, you can once it's on our screens, you can walk us through it. I figured that made more sense since you and Ethan did all the great work.
Can you guys see the screen, the spreadsheet?
Yes.
Great.
All right, thanks, Al Lebo, board member. Yeah, so what we did here was we actually have three separate tabs. So this first one that you're looking at is sort of the, you know, broad overview, and all we actually did here was to take the average deterministic scenario as presented, you know, by Milliman, and sort of spread it out to add actual columns next to each of the columns that were presented as expected. And so the thought here is that this would allow us, you know, to take a look at, you know, on an ongoing basis, what actually occurred versus what was expected to occur. Now, you know, this is a 20, 30-year projection. The idea that 20 or 30 years from now, we'd still be looking back at this, you know, clearly could change. But the thought was, you know, for a broad overview, we would at least sort of get our bearings by saying, you know, on the left-hand side here, this is the, you know, the 6.25% that we've talked about, and that was expected every year. you know, how did the markets do, or how did we do compared to that 6.25? What did that mean then as far as, you know, the liability growth and the asset growth and the unfunded liability, you know, just all the way across the board here. How are we doing versus what was expected? So this is just to sort of get our bearings, and then the next two tabs go into more detail. So I'm not sure. I guess I'll take a pause here before moving on to the next two tabs.
Peter, question?
Yeah, Pete Privitera, a board member. Alan, I just wanted to give you a heads up that after the bonds were sold, a new version of this came out with the actual numbers, and I thought that was forwarded to the board. If not, I can certainly send it to you if you want to update this. For instance, the debt service on the pension bonds annually is about 17.7 million now, not 20.9 million. I mean, I can get you all the updated information, including the projected ADEC moving forward, if you like to update this.
Great, thank you, Peter. And yeah, certainly we can use the, you know, official last version, and still the same thought here, just plain, you know, track how things are performing versus what that final version was.
Any other questions for Alan on the first tab?
Okay, so moving on then. Again, the first tab here is sort of a broad overview. The next two tabs are to sort of focus in on you know, individual year results for the liability side and for the asset side. So this tab that Lori has brought up is the liability one. And the thought here is, again, the beginning value here, the 301.7, that you can actually find on the first tab. That's you know, that's what was established as the beginning value, and the ending value here as well exists on the first tab. And so what we're doing here is trying to break down the components of how you get from one to the other. So the expectation was, you know, as far as the liability goes, that in the first year it would go from 301.7 to 315.2, and the numbers in here are made up. We would need the actual numbers, and Milliman would have to help us with that. But there's a certain, you know, the way you get from the way the model got from 301 to 315, it had to assume a certain amount of contributions, a certain amount of claims, you know, would occur, a certain valuation interest rate, amount of valuation interest would be added, and then there would be a number of retirements and a number of deaths, and then I mean that makes a lot of it. There would be no assumption of change of other changes, so those would be zero on the expected side. But then every year, what we would want to look at is, well, what actually did happen? How did the contributions compare to what was expected? How did the claims and withdrawals compare to what was expected? How did the valuation interest earned compared to the interest earned expected? And then, you know, did we have more or fewer retirements? How did mortality compare to what was expected? And then, you know, to the extent that there were any assumption changes or any other things that impacted the results, how did that occur? So the idea here is each year to get a breakdown as to why are things tracking the way they are, and what do we need to do to sort of get back on track. Now, the idea here would be that the expected would be reset every year. This expected in the first year here, you know, would tie to that first sheet. In future years, we wouldn't want to be, you know, starting with an expectation that was already not met. So every year this would be reestablished with, you know, what is the actual starting value, what is the expectation, and how are we comparing to that? So again, I'll pause here.
Peter?
Pete Privitera, board member. Alan, just a quick question. The contributions, is that a combination of the ADEC plus employee contributions?
Yeah, it is, but we certainly could, break that down for more detail if we wanted to.
I don't know if it's important or not, but I have to approach this now from a total pension liability, which is the debt service and the ADEC moving forward. I didn't know if you wanted to state that anywhere in here. But actually I guess that's the town's issue, not the pension board's issue. Because when I distribute the liability to all the departments, including the Board of Ed and everyone, it's a combination of debt service and ADEC, but that's not going to affect this. So I guess I'm just talking out loud here. I don't know if it has any value or not, but just to state that.
Yes,
It's something that we can think about, and maybe Alan, kind of think about that a little bit, kind of offline, if we want to include debt service here, and how we might factor that in, if that's something we want to focus on as well.
yeah, absolutely. And Peter, if you've got a suggestion, let's either send it to me or suggest it. That'd be great.
Great, thank you.
Any questions? Any other questions for Alan on the liability attribution tab?
Yeah, I have a question for Alan. This is Perry Salonia, board member. So how is it that we would be retrieving some of this information? Let's say mortality, for example. Is that something we're just going to be going to the actuary on in order to fill some of this information? Or is it we would actually present this model or tracking to the actuary for them to populate themselves? So I'm just curious how you envision this would kind of operate going forward.
Yeah, thank you, Perry. Good question. Yeah, the actuary would really need to generate these numbers for us, and so one of the issues here will be talking to Milliman and seeing how able they are to do this. This, in my mind, this is not something that's difficult to do. It's something that I actually do in my line of work every day. I wouldn't expect this to be an issue for Milliman, but it is that's something that we would have to discuss with them.
Yeah, I think just for everybody's benefit, the idea was let's sort of agree on the framework as a board and not necessarily bring the actuary to this meeting while we're still sort of hashing out some of the details. But one of the next steps is definitely to bring them in, make sure that the data is not overly burdensome or to get, because obviously that's going to impact the time that it takes them is going to translate into fees. So far it looks pretty pretty straightforward and a very effective tool to help us manage. But the next step would be to bring in Becky, make sure that again it's not overly burdensome, and then hopefully they can just populate. In terms of frequency, maybe we should quickly talk about frequency. Alan, was your thought just sort of in conjunction with the valuation when they're looking at a lot of these numbers anyway, to sort of populate this for us in parallel?
Yeah, my thought was that we would do this annually. The valuation has been biannually till now. I don't know whether we plan on changing that, but the thought was to look at this annually.
Go ahead, Perry.
Okay, yeah, Perry Salonia, board member. So I know the valuation is by every 2 years, but the town is obviously subject to GASB, so they do have some annual reporting where I believe they break down some liability attribution between assumptions, some actuarial gain loss items. I don't think it's to the level of specificity that's in here For example, when I say actuarial gains or losses, mortality, retirement, termination, those things are usually lumped together. So we could talk to Becky obviously when we're ready, but it's very possible that she'll say it'll cost some to give us this level of specificity, but maybe we'd be open to kind of taking some of these items in a little bit more aggregate fashion. But obviously, we'll just let her tell us what they can do, and then we can decide what makes most sense given the cost that might be associated with it.
Yeah, I think that's the plan. Thank you, Perry. I saw Peter, you had a question?
Just a comment. The full valuation is done every other year, but there is a statistical valuation that's done in the interim year. So we do receive a valuation on an annual basis. The question came up a while ago. Is it worth the cost and effort to do a full valuation on an annual basis? And that's really a decision that the board would have to make. But some of this information that Al is looking for, I believe, is already in the annual val anyways. So it might be just a question of getting some additional information from the actuaries to make this complete.
Agreed. Al, walk us through the last tab, and I think we still have a few things. This is great. Maybe just let's keep it high level, and then we'll move forward. But this is great work. Thank you.
Just a couple more comments on the liability tab before we move on. As Peter said, most of this stuff is available, and I wouldn't expect there to be a lot of difficulty in producing this. The one thing about it, though, is there is a bit of, which came first. So when you do this kind of thing, you sort of have to look at the impacts here sequentially. And so, if you say how much were the claims, if you look at that before you look at how much was the valuation interest, or you look at those before you look at how much is the retirement, you get a little bit of different answers. So one of the things we do have to talk to the actuaries about is, what's the sequencing here of impacts to understand them, because they impact each other. And so if you say one happened first, then it changes how much the other one happens. So there are little nuances like that have to be worked out as well.
Okay.
All right, if we can move on then to the asset tab. Thank you, Lori. So the same thing here. What we want to do is understand how did assets perform versus what was expected, and the factors that come into play here are the beginning assets, the yield on those assets, the cash flow that occurred, and again we can break that down into claims and employer contributions and town contribution, but what impacts the overall answer here is the yield that we got on assets and the net cash flow that occurred. And so the idea is to compare the expected beginning and ending assets to the actual beginning and ending assets, and why did we get there. And then as far as understanding that goes, then there's this further breakdown where as far as the yield goes, there's a few different components here. So in the example that's shown here, we're saying we expected $13.52 $1 million. Yeah, I just want to make sure that what I'm looking at was the same as what you had. 13.52 million, and that what we actually got was 6.9. And why is that? Well, in this particular example, if you go down to the second group here, you can see the 6.9 million there is the actual realized return. And then there's these two other measures. And the first one here, return based on the actual proxies and mix. And the second one, the expected return. What we're doing here is we're saying, well, there were proxy funds that were used in determining the expectation. And these are the actual proxy funds that were used in putting the model together. So you can see there's the, Barclays, there's the Russell 1000, Russell 2000. So these are the funds that were used to estimate what kind of returns we would get. And so in this example, it's saying, well, in this particular year, those proxy funds actually earned less than was expected. We expected 3% on the Barclays Ag, and we got 1%. We expected 8% on each of the other ones, and they got less than that. And so part of the answer as to why didn't we earn as much as we expected was because it was a year that the markets didn't return as much as expected, and then that gets compounded by the asset mix. Again, we had a expectation here as far as which funds we would be invested in. What we were actually invested in might have been different than that, and so part of the answer here is the return based on what we were actually invested in and how those proxy funds performed, and then the rest of it is how did our funds actually perform versus these proxy funds. It's something that's referred to in the industry as a basis mismatch. So the idea here is just to break down, give a little bit further information as to how we performed versus what was expected and why that was. So I'll pause there.
Alan, let's use the Barclays Ag as an example. There's the expectation for what the Barclays Ag was going to return that given year. Then there's what the Barclays Ag did return that year. And then there's what our manager that populates that category actually returned that year. So I don't know how detailed you were trying to get, but I was just curious. Are we going to put in here when you say, are we adding the manager return here or just looking at the proxies, how they did versus expectation?
Yeah, thanks. So in the top half there, you can see that we expected $13.592 million return, right?
Yep.
And that ties to the bottom right-hand corner here, the 13.592 expected return. And that corresponds to a 6.5% average return. That 6.5% ties to Barclays earning 3% and us being 30% invested in that, and right. The mid cap earning 8% and us being 30% in that. So that's how we came up with the 13.592. Was these expectations of investment mix applied to these expectations of what the individual proxy funds would earn. At the end of the year, then we do know, it's published, what did the proxy funds actually earn? And it turns out Barclays had a 1% return and midcap had a 6% return. And it also turned out that we were invested 28% in Barclays and 33% in midcap. And so you do, multiply that out, and that gets you the 3.5%, and that corresponds to the 7.339 million. So that was the thought there. And then, we know what we actually returned. That's, we actually got 6.9 million. So that's how you get that number. So that's how we would be able to populate all these values.
Okay, the 6 point, my question was the actual, okay, so the actual is really not our, okay, because we're not really invested in Barclays, we're invested in MetWest. Yeah, that's basically, that's the 6.9. And so, okay, no, that makes sense. All right, any other questions for Oh, actually, before we actually, any questions for Alan on the asset attribution?
No question. I just want to say, Alan, this is great. Thank you very much. I think this is a really nice thing that you put together, and it will help tracking this thing going forward. So I really enjoyed going through it. Thank you.
Yeah, definitely, Alan, and thank you. And I'm going to reach out to Ethan and thank him for his contribution. I think this is really helpful. And you know, just I think I've said this before, but the way that I envision using this, I mean, one, it's understanding what's actually happening in terms of our actual experience versus the original expectations. But I think the other big component is, you know, as we start to deviate, and we know we're going to deviate from the expected, right, from the plan. So as we start to deviate, you know, we can in real time sort of look back and say, okay, you know, we know what we can control as a pension board, which is the asset allocation. So if we start to deviate in a positive or negative way, then, you know, we come back and say, okay, we're deviating, and do we want to make any changes to the asset allocation, or do we just leave it the same, recognizing that, you know, obviously we're not going to earn a smooth 6.25% return. It's going to bounce around. So part of that is just, you know, kind of understanding the attribution and maybe, you know, continuing forward on the same path. But I think at least now we have a tool to sort of track how things move relative to expected, which is great, Alan. So much appreciated. Before we leave the tab, Chris, we're going to count on you sort of to help populate, you know, like we did for the liabilities. We're going to rely on the actuary. On the asset attribution, I think we're going to rely on you and your team. Do you see anything here that is overly burdensome in terms of tracking?
No, Mr. Chairman, happy to help, and that was our expectation as well, that we can help you source a lot of this data.
Thanks, Chris. All right, any final questions for Alan? Again, thank you, great work. All right, next on the agenda, we've got Peter Privitera, Director of Finance.
Good morning, everyone. Pete Privitera, Director of Finance and Board Member. I don't have anything specific. I just do want to share with the board that, as most of you know, the town issues debt every year, and this year we're issuing next week. Last week we had a ratings call with Moody's and S&P, and part of the ratings call was an overview of what happened with our POB sale and where we stand. And I've been talking with the actuaries. They're working on the valuation. They don't have a draft hard copy for us yet, but they were able to share some numbers with me, and I'm happy to report that when the valuation is released, it'll show that the pension fund went from a 40.6% funded ratio to a 101.5% funded ratio. When we first started down this path, and thanks to the mayor for pushing us down this path, we had two targets. One was to fully fund the pension liability, and the other was to give the town some budgetary relief. And I'm pleased to report as well that the preliminary pension liabilities numbers for next year are $2 million less than what they would have been if we hadn't done this. So I think we achieved both a fully funded pension and reducing the town's overall pension liability, a combination of the debt service and the ADEC moving forward. So we're very pleased with it. And I believe the rating agencies were happy to hear that as well. So I just wanted to share that with everyone. Thank you.
Great. Thank you, Peter, for the update. Questions? Al, go ahead.
Thank you, Peter, and congratulations. That's great. Just curious, did the rating agencies have any thoughts, you know, about issuing debt, considering that, you know, we've just issued this new, you know, POB debt?
That's a good question, Al. Pete Privitera, a finance director and board member. You know, basically we're looking at it, and I think they're looking at it from the same perspective. We're trading one liability for another liability. you know, the prior service liability is now, you know, being satisfied with the pension bonds. So, they're looking at as I guess, I don't want to call it break even, but, they had no concerns, about us being able to manage that debt. Our debt profile has increased, and some of the metrics the rating agencies use to rate municipalities, a debt metric is one of them, but another metric is the annual the ADEC. So one went up and one went down, and based on our conservative approach, I think they were happy with the outcome as we were.
Hi, Perry.
Perry Slender, pension board member. Peter, when was the most recent actuarial valuation report that's finalized?
Pete Privitera, board member. That would have been last year's report. I can get you a copy of that. We will have our valuation report in time for our next board meeting, but I can certainly get you a copy of the last pension valuation.
That would be great. Thank you.
Okay.
All right, next we've got Brittany, Birmingham, to talk about town matters.
No matters to report.
Great, thank you, Brittany. Rick, Executive Director of Human Resources. I think you were going to give us an update on the meeting schedule.
Good morning, everyone. Rick Ledwith, Executive Director of Human Resources. Our meeting schedule can be found on page 7A of your packet and has a schedule for the remainder of the calendar year, which we also reviewed back in December. The next meeting is February 28th. Thank you.
Great, thank you, Rick. All right, formal actions. Everybody received the minutes prior to today's meeting. I did want to make a motion to unanimously approve those minutes. So unless anybody objects, we can move forward with unanimous consent. Anybody object to approval? Motion carries. Let's see, pension administration.
Rick Ledwith, Executive Director of Human Resources. Nothing out of the ordinary for pension administration. We added 23 new members to the plan. We had 4 non-vested withdrawals, 1 vested withdrawal, and 1 member who previously purchased retirement credit but will not use those years towards their calculation. So the plan does refund those funds to the member when that happens. Any questions? I'd be happy to answer any questions that the board had.
Any questions for Rick? If not, motion to approve pension administration, and again, make a motion to approve those unanimously. So unless anybody objects, we'll move forward with approval. All right, Lori, motion carries. Actually, you know what? Chris, are you still on?
Chris
had
had
a
to, yeah, he had to leave at 9 o'clock.
Yeah, he had to leave, and we had the Pure Capital. All right. Well, we're gonna approve that invoice. So okay, let me just move forward with the agenda then. Let's see. We've got invoices for consideration. Starting
Yes, we
with
have invoices from Fiducient Advisors. We have Wells Fargo bills, Pure Capital, the one the chairman just mentioned, as well as GHG Corporation. And at our last meeting, pension board member Lebo had requested some backup on the Milliman bill from last month, which was provided in the packet. So I don't know if that satisfied that request. Be happy to answer any questions that the board had.
let me pause there. Alan, did you have a comment?
No, I'm a LIBA board member. I typically when consultants provide services, they break it down into 10-minute increments as to, you know, what was provided, not sort of this broad-based sort of, yeah, I spent 6.5 hours of my time and 6.5 hours of Ilana's time. And I just, I wasn't terribly satisfied with what we received here.
I guess, are we in a position, maybe in terms of going forward, maybe we can talk to the actuary just in the for future documentation. Maybe we'd like a little bit more breakdown. But for the purpose of just satisfying the request, are we comfortable enough to move forward, or do we have a follow-up request here, Alan?
I mean, I don't think we're going to get a whole lot more, and you know, I don't really want to make it more of a deal out of this, but it does feel to me like whenever we're receiving services from a consultant and from these actuaries, that the invoice should come with a breakdown of what services were provided and what kind of time increments were involved in that, and we should be reviewing that before we approve the payments.
Let's look at that, and then maybe, you know, we'll see how, you know, how going forward we might, you know, we might get a little bit more documentation going forward. But I think, again, for the purpose of just this specific request, you know, I think we'll mark it as completed. So I'm gonna make a motion to approve. Let me just make sure we've got all the invoices. So there was Clifton, Larson, Allen, and GHG Corporation. Anything out of the ordinary here that anybody, Rick or Lori, that we need to consider from your perspective on some of the, I'm not sure I heard some of the 6 and 7 addressed. And if they were, I apologize.
Well, I could just mention the GHG invoice, just to explain that. And Peter, you can jump in if you have something to add, but for active employees and for retirees, we have a system whereby review their pension pay stubs and the direct deposit. And so my understanding of this invoice is that it's for that service, and it's broken down to actives and retirees. And so $1,785 is proportioned for that service for the pensioners.
I'm sorry, can you repeat that? Repeat what I missed the beginning of that.
We have a service that allows active employees and retirees to view their pay stubs for retirees. That's on a monthly basis. For actives, it's biweekly. And so they're sent a link. That link it takes them to this EEMS site, and they can view their pay stubs, print off pay stubs, and so forth. And so this is a bill for all those services, and it was proportioned to actives and retirees, and with retirees, a charge of $1,785.
Lori, I'm Privitera. Lori, I think this is a new bill because of the activation of the employee service portal. And Rick, you may want to jump in on that, where now all employees and I believe retirees have access to that, so they can go online and they can review any pay stubs or pension stubs and get information.
Well, my understanding is that we've been paying on this bill even going back to 2017. So I think it's the it's the service we've been using and that retirees are still using because they're still on the old payroll system.
That's right. That's right. That's right. So I guess I have to go back and calculate the payment to 2017.
I think it's been proportioned because Lisa had showed me that
Okay.
historically we've broken it out by actives and retirees, so it's been done historically.
Okay.
And the reason this is being charged to pension assets is because retiree, not just employees use it, but retirees use it as well.
Right. Right. Almost all of our retirees have direct deposit set up for their monthly pension check. And so this is there's no pay stubs mailed out any longer. They view their pay stubs through this service.
Alan, did you have a question?
Yeah, Alibo board member. I mean, this is a surprise to me. This isn't something I had known about or expected to see. Are there other services that are provided that are billed to the pension plan that, like, we could get a list of these are the various companies that, you know, will be billing us annually, and an expectation of how much that might be?
I guess I'd ask Peter to
Yeah,
answer that since
I believe all of the outside companies, and I wasn't aware of this one, obviously, but all the outside companies that we receive bills from are eventually presented to the board. What you don't see is, you know, the administrative support services that the town provides to the pension fund, a percentage of everyone's time, including payroll and accounting, and we can certainly give you a breakout of all that. But any outside agency that bills us on behalf of the pension fund, we would present to the board. The problem we have is that the board doesn't meet every month. The board meets 5 or 6 times a year, but we get these bills throughout the year. So when we see something we think is we can apply to the pension board because it's a pension bill, we will pay it and then we'll present it to the board for future approval.
Yeah, and I don't have any issue with that. If this is a service that's been being provided to the pension board, then it's something we had the ability to know about before the bill came. And I'm wondering if there's a way we can say, hey, these are the various services that are provided to the board and companies that are likely to bill us, and sort of an estimate of what that bill might be.
That's fine. We can do that. You know, I do know, and we are in the process of upgrading our financial system, and one of the portions of the upgrade is the HR portal, which means we would provide more services and more access to our active and retired employees eventually. Something like that, if we acquire a software that makes it easier for active employees and pensioners to view certain documentation, we're going to do it on an enterprise-wide basis. And if there's a portion that's, you know, attributed to the pension piece, we'll charge it back. But I'll try to get you a list of all of the outside contractors that send us bills, and I can work with Lori and come up with an accurate list. And I'm not sure why this didn't come up on anyone's radar in the past. Maybe it was just the bill was just you know, paid and a portion of it was paid from the pension fund, but I'll certainly come up with a list.
Thanks.
Thanks. And then there's the audit, Clifton, Larson, Allen. Can anybody just quickly comment on that one, if that's just standard audit fees, $25,000?
Mr. Chairman, I think, Lori, didn't we take that off the final agenda?
yes, it
Yeah,
was.
it's not on the current agenda.
Oh,
Yeah,
I might
Mr.
have
Chairman,
printed it.
that's the annual fee for the town, and it shouldn't have gone on the agenda. So
I don't think it's there, is it?
It's
No,
not. in
I
the-
must have
the
pulled the
version.
wrong, I must have pulled the
Because
wrong version,
I
Laurie.
sent you, yeah, I had sent you a draft, and then that's subsequent to that, that was removed because it didn't apply.
Okay. All right. So based on what we have, let me just make one comment on Pure Capital. So the fourth quarter, they outperformed by, by quite a bit. So their bill, their most recent bill was higher than the bills we typically get. Chris was going to go over sort of, in the past, we've considered whether we should pay them a flat fee or have this incentive fee. And in previous discussions, we've always elected to maintain the incentive fee, which has a smaller flat fee component. But then, when they outperform by a decent amount, they're gonna get a total, they're gonna collect a higher total revenue. So from my perspective, I think, given that the current bill reflects the current agreement, we need to move forward with paying that invoice. And then maybe at the next meeting, we can still have Chris, I do want to circle back with the board and then just have the discussion again, whether, we should continue to have the incentive fee or pay a higher flat fee without an incentive fee. So we'll kick that to the next meeting. But again, I think for the purpose of just approving the invoices, we have what we need at this point. So I'm going to make a motion to unanimously approve the invoices, and let me know if anybody objects. Hearing no objections, motion carries.
Thanks, Lazaro.
Thank you. Thank you, everybody. And with that, I'll make Al, go ahead.
Yeah, could you check the chat from Sherry and see if you want to make a comment there?
Let's see. I've got a chat from Chris. I'm not sure if that was only sent to you, Al. I don't.
They
Chairman, I
go to
can-
everyone. I can comment on
Rick can
that,
comment.
Mr. Chair.
Okay.
So Matt Hart, I don't know if folks saw the announcement from about a month ago, but Matt Hart, our town manager, has announced that he is leaving the town of West Hartford to become the executive director of CROG, which is great for Matt, and actually it's great for us as well. We will have a lot of involvement moving forward with Matt, and his expertise and leadership will be very important to the town as we move through these next couple of years in this new role that he has. I will be, the council will be voting tomorrow to appoint me as the acting town manager. So, so I will take over, attempt to take over for Matt and fill those rather large shoes. And that will take place starting February 4th, and we'll move forward over the next couple of months. So I'll still be involved with the pension board. I'll be attending the meetings, but I think Lori will probably, and we'll talk more about this at the February meeting, but I think Lori will take over my role from a pension board responsibility, and then Paul Kanacki would take over for Lori potentially as the clerk of the board. But we will talk more with Lazaro. We'll certainly touch base with you in the interim, but that may be a plan as we move forward for the next few months.
Great. Thank you and congratulations.
Thank you.
Anything else before we adjourn? All right, with that, motion to adjourn. No objections? All right, move forward unanimously. Thank you, everybody, for your contributions and your time. I think it was a very productive meeting. So until next one, February 28th. But thank you again.
Thank you, everyone.
Bye-bye.
Thanks, Lazaro. Happy New Year.
Take care.